Hey guys, today I was thinking I would give you guys a little introduction video on how to use some of the buy and sell options in the Binance futures. I think it's always helpful to kind of go over these as I've been trading for about the past week on this platform. I've confused some of the limit orders myself. I missed a few trades because I set the price either too high or too low and it didn't trigger, and I've closed a few positions by accident as well. So I thought I would just go over, how to use these, what they do, and kind of when I use them and when I should have used them. So to begin with, we are going to start with the market order. This is the most basic, I think most easy to understand buy and sell order you can do. So the purpose of the market order is it'll immediately go. If you're buying, it'll immediately buy, and if you're selling, it'll immediately sell. The idea is that you're going to the market. And what that looks like is here. So if you look in the section, whatever trading platform you're using, it'll have their order book, and this tells you who's buying and who's selling at any given time, and how much, and and a price. So for example, the ETH thing, if you're going to make a market order, you would be able to sell this many at this price, and it moves up. It shows you the top 2, 4, 6 cells here. So and it sums them up nicely. So you can sell 1,700 Ethereum, basically, and this will be the highest price that you'll pay. So this you can consider this as slippage. Slippage is basically the difference in the price that you trigger the order and how much the price changes when your order actually fills. And when I first started, I was using market just because it is the simplest, but I was losing a lot of profit, and my losses were a little bit bigger than they should have been because you're leaving a lot of money on the table, or you can when you hit a market order, because if you're selling more than this bottom one, then you're going to move up the next rung to the next higher price, higher price, higher price, higher price, higher price until your order has been filled. And so in terms of in periods of high volatility, that the delta here, the differences can be substantial. So I would only use a market order sparingly if there's a lot of liquidity at the time. If you really need that order to fill like instantly, um, if you need to exit a position or you really need to enter a position, so things like that. And something to be aware of when using a market order is slippage. So moving on to the next one, and this is also a fairly basic idea, and it's definitely one of my favorites. The limit buy and the limit sell, and these can be a little bit confusing. So basically, what you're going to do is you're going to be able to say what the highest price that you want to pay is, or the lowest price that you want to pay. So a limit buy order is going to fill instantly above the market price, and it'll wait. If you pick a price below the market price, it'll wait until you hit that price. So what that's going to look like is if I put a limit buy order for Ethereum. This is the Ethereum 1 hour chart on the Binance futures. I can pick the highest price that I want to pay. And just for example, maybe I'm thinking that this is actually going to come back down and then probably take right off. So say, I think it's going to come down to, 400, just to give a price. So I would put in 400 here. And size, you can pick any size. We'll say half an Ethereum, maybe 1 Ethereum. So that means this order won't fill until it comes down right here. And anything below this, it'll fill. So if it keeps going down, it'll fill, doesn't matter. And so that's how the limit buy order. The limit buy order works. And so just to recap there, it fills above. It'll fill immediately. So if I just say that the highest price I want to pay is $405 for an Ethereum, if I already think this might be a good deal or something, or I just want to fill, then it'll fill. And I actually kind of use this quite a bit. And one of the skills here is figuring out if it'll fill right away, and it's kind of a balancing act. Because like I said, if I use a market order, I'm prone to getting a lot of slippage. So what you can do is set a limit order that you think will fill, but that'll still guarantee not too much slippage, and that'll get added to the order book somewhere, depending on the price you give. So that's what happens. If you put a limit order in, it goes to the order book, unless there's a matching right away. And I could do a later tutorial on how that affects your fees, like maker and taker fees, and we can go into that a little bit later with things like the post only option. So a sell, or a short limit order, is going to fill anytime you're below the market price. So if you really want to fill it, instantly, and you want to guarantee a price without risking slippage, you would set it just below the market price. Or you could, set it above the market price to sort of wait till it reaches that target price to fill the order. So these are the limits. They're really nice. They're also fairly simple. And so, if a buy fills above, a sell fills below, things like that. And again, I just kind of use this to avoid slippage and to sort of guarantee like a decent range that I'm comfortable with. And you really have to be careful here, because I have accidentally set the order on the wrong side of the market line when it's like on a tear, and you miss the trade. I looked back a few minutes later, I realized it didn't fill, and I was like, oh, just missed like a couple percentage points. That would have been nice. Okay, so the next one, and these are super important, are we're going to do stop limit and stop market orders. They're both kind of the same principle. So once you understand a basic limit order, all the other order types just kind of build upon these. So a stop limit is like a stop loss. It's called a take profit or a stop loss, depending on if it's above or below the price, and if it's a buy or a sell order. So a stop loss, lots of people are familiar with, and you can either use a stop market or a stop limit for your stop loss. So the one I personally prefer, I'm not a big fan of market orders, so I personally prefer a stop limit. And this lets you set a limit price, which they call a trigger price, and then a price that you're actually comfortable with taking. So again, to our Ethereum example, if I went, well, this is an uptrend, we'll say I went short here, and I think the price can keep dropping, and the price takes off like a rocket. So on my short order, I would set a trigger price at a point where I want this to turn into a limit order. So I think this is kind of an area of value. It's the highest high in the past few days. So 405.58. I'm actually just I'm going to set it a little bit above that, just in case of trend reversal. It's an area of value. And what that happens when it crosses that price, it's going to turn this into either a limit order or a market order, whichever option that I've chosen. So in this case, a stop limit. And now basically I can set my limit price. So this is going to trigger the order. It's going to become live. It's going to be a limit order once you pass this price. And now you can set whatever you want to take. So again, if I want to fill immediately at that price, and this is going to be a buy to cover my short, then I'm going to set it above that price. So I would set it at 4.78. And what that's going to do is it's going to pretty much fill immediately between these prices, hopefully. So one thing that can happen, and this is where a lot of people make a mistake, is they set the trigger price and the limit price too close together. And in periods of high volatility, you can skip that price entirely, and basically your order is going to go above the limit, and it won't fill. So you have to be careful to set these prices far apart, because if lots of people set these as at the same, and what will happen, for example, this is telling you what the best price that you're willing to take for this trade is, and if it starts at 407, something like this, and it zooms right past that, in the next basically the next sell order is a little bit higher than that, you're not going to sell. You're not going to close the position. So make sure to set these a comfortable distance apart. I've been using something like it depends on obviously what you're using and what the distance is. But for something like this, I would go like a tenth apart, 0.1. 10 cents apart, and I think it'll work just fine. And a stock market is very similar, except you don't have a limit price anymore. You just have a trigger price. So again, same example. If I was short here and it was going up, I would just set it at something like here, 405.95. This is going to be a stop loss, and at that price, it's just going to execute a market order, which we've already talked about will just fill according to the order book. So that's these two. These are my favorites. These are going to be your and before I forget, the opposite of that is the take profit. And again, use this the exact same way. So if I was short here, and I don't really expect it to go lower, maybe than say 395, for example, I would set my take profit at maybe 396.26, and this is going to become a take profit order. And as soon as I reach here, again, it's just going to fill in a market order. Now, I don't really like using market orders. They're kind of risky, unreliable, often. So I would just return to here. Take profit now. You're just going to flip these if you want to fill right away. So my target price would be 396, we'll say. Or trigger price, sorry. And then don't forget, I just want to set it a little bit above. Yeah, because I want to fill right away. So I'm saying I'm willing to take a price even a little bit higher than that, so 397, and it'll fill. Hopefully not above that. So yeah, so that's your take profit, your basic take profit, and your stop loss orders. Definitely recommend using these. I use them pretty much anytime I walk away from a trade. They're not so important in my opinion if I'm watching, but even if I'm watching a trade, they really help me to kind of keep track of my losses. It's easy, in my opinion, in my experience. I've been losing money, and I'm like, it's going to turn around, but if you've already got a stop loss, it really just helps you keep perspective, and just cut your losses. And so far, I've seen how so many people have just mentioned how important it really is to stick to that and cut your losses. Before it can get very emotional very quick. There's one more order type that I would like to look at called a trailing stop. I personally, I've used one. I used one today somewhere, yeah, and I don't really recommend them. They're great in periods of like large volatility. Like if you're on a rocket or you're dropping like a rock here, basically what this does is it lets you set a trigger price, which we talked about. This is going to turn this into a live trade, whether you're long or short. And at this price, it's essentially going to turn into a market order, which again is one of the reasons I don't particularly like these very much. But we'll say we're sticking to a short position, and I think it's coming back down to 400. So I said at 400, this is going to become a live market order, but it's not going to fill at this price. You also have this callback rate feature, and the idea behind this is I don't want to limit my gains, but I also want to cut my losses. So callback feature, you set a percentage at where you want this to trigger. So what this means, if at 400 it becomes a live trade, it's going to wait. It's not going to fill until that climbs back up by whatever my callback rate is. In this case, 1%. So 4. So this will fill at 404 essentially. It'll come down to 400 and fill when it comes back up to 404. Which in this case actually wouldn't be great. I would lose money. I mostly think these are awful trades, but lots of people use them with good effect. You can put in a 0.2% here, something like a 0.1%, but also this won't capture a bounce. But they are effective in the sense that if this kept dropping to 380, and maybe I missed this, maybe I had a basic limit set somewhere here, which we already talked about, I would miss out on all this profit. So the idea is that it drops, and this 0.1% follows this drop, and the lowest price it won't trigger until 1% back above that. So it's a little bit of a gamble. Again, not my favorite type of trade that you can make, but definitely an important one in an investor's toolbox. So I hope this helped, and if you have any other questions, just leave a comment. Thanks so much.